Ladies and gentlemen, welcome to the Scaling Private Finance to Achieve Paris Climate Goals webinar, hosted by Climate Policy Initiative and the International Finance Corporation. This webinar will be presented by Dr. Barbara Buchner, Executive Director of Climate Finance at CPI, Tom Kerr, Principal Climate Policy Officer at the IFC, and Patrick Oliver, Manager at CPI. The format of this webinar will be a half-hour presentation followed by a question and answer session. All attendees will be on mute, but during this time, you're welcome to submit questions by typing them into the chat box on the lower right-hand corner of your screen, and we'll address them after the presentation. As a reminder, the webinar is being recorded and will be available online in the coming days. And now I will turn it over to Barbara.
Great. Thank you so much, Caroline, and thank you to everyone for joining us today on this webinar. Let me just very briefly set the context and explain a little bit on why we continue to focus on finance in our work and also together in the collaboration that we have with IFC. So as you know, the two key challenges that we are facing in the 21st century is climate change, and I think everyone will agree that emissions today are on a path that is dangerous to future generations, and we certainly are not yet on track to meeting the goals that have been enshrined in the Paris Agreement. But at the same time, as we address climate change, there are urgent development needs to end poverty, to alleviate world hunger, to enable access to energy, and to address a number of development challenges that are embodied best by the UN's Sustainable Development Goals. So climate finance at its heart is really about tracking investment to address these challenges and to showing us how we are doing towards the goals that we have set ourselves. And so with that, let me hand over to Patrick Oliver, who will walk you a little bit through kind of the latest state-of-art snapshot of how we're doing in terms of investments that are targeted towards climate-relevant activities. Patrick?
Thank you, Barbara. I'm just going to go through some of the key findings from our Global Landscape of Climate Finance published last November 2017 ahead of the COP. For those of you who may not be familiar with the publication, it's a series of global landscapes that we've been doing since 2011 on annual climate finance flows. And this is what we term is our spaghetti diagram, which is the main output of the report. It provides us with the who, the what, the where, and the why of climate finance flows over a given time period. And I'll be going through some of those main findings here, but you can find out more about how this diagram is constructed in the report. That's available on our website and also on a dedicated interactive website at climatefinancelandscape.org. So where do we stand? In terms of the annual 5-year trend, we see that climate finance flows reached a record in 2015 of 437 billion, followed by a 12% drop in 2016 to 383 billion. And there is a lot of focus on this drop, but we think there are two underlying positive stories. Firstly, there's a good upward trend across the years in our data set from 2012 to 2016. And secondly, with falling technology costs, we're actually getting more value for money for each dollar that we spend in terms of our climate mitigation and adaptation potential that is put in there. So taking into account normal annual fluctuations, the average flows across 2015 and 2016 are actually still 12% higher than the average over 2013 and 2014. Here are the annual estimates for those 5 years split by public and private sources of finance. As you can see, the private sector is doing more of the work, with investment growing to 299 billion in 2015 before dropping back to 242 billion. At the same time, you can notice how there's a strong and steady public investment across those years that provide a good foundation. Approximately about 1/3 of the total flows that happen each year or more. Now this webinar is about scaling up investment to reach Paris goals, but we were also interested to see if the negotiations themselves in Paris had an effect. And we were considering this because of all of the actions and announcements that were announced by governments and investors in the lead up to the Paris Agreement at the end of 2015. And while, as you saw in the previous slide, the quantitative increase was due more to private finance flowing, due to the falling technology costs and strong policy environments. That said, we did notice some signals that momentum may have made a small difference in two segments. First, there was the direct investment by institutional investors. This went up from 1 billion in 2014 to 3 billion in 2015, and that may have been mobilized itself through the various investor engagement initiatives that were very prominent in the lead up to Paris and shortly after, and continue to be. And the second segment we thought was interesting was how the Green Climate Fund has now come onto the scene, replacing much needed low cost or risk taking capital as other multilateral climate funds have reduced their spending. The Green Climate Fund committed 2.6 billion after getting capitalized towards the end of 2015. So do these flows mean that we are on track to realizing a low carbon and climate resilient economy? Much of the private sector activity is a sign of maturing renewable energy markets. The investment in solar PV and onshore wind specifically has led to deployment levels that mean that they are on track to meet what the International Energy Agency considers the amount of renewable energy in those sectors that need to be deployed to give us a 50% chance of limiting global temperature rises to 2 degrees. Nevertheless, the solar PV and onshore wind sectors are only one part of one sector across the whole economy where investment is needed. For energy use in other electricity technologies, transportation, buildings, the needs total over 1 trillion per year through to 2050, and even more is needed in agriculture, forestry, water, waste to enable a low carbon transition, not to mention adaptation finance as well to minimize the costs of climate impacts. And where will much of this capital come from? We think it may yet come from a shift from high carbon activities. When we consider total upstream and downstream fossil fuel investments, we found that they amounted to 825 billion in 2016, according to the International Energy Agency. So much of this investment may be wasted capital in potentially stranded assets that could be redirected towards meeting our climate investment goals and needs. On adaptation, our estimates show that despite ambitions within the Paris Agreement calling for a scale-up of adaptation finance, overall finance to that area remains a challenge. This graph shows the proportions of public climate finance. So this is not the total climate finance figure, but only the public flows. And adaptation flows of public climate finance decreased from 18% during 2013 and 2014 to 16% over 2015 and 2016. We found that this was largely due to a reduction of adaptation finance from national development finance institutions. We found, for example, that it's also important to consider how multilateral development finance institutions have actually stepped up their adaptation finance by 29% in absolute terms over the period. So is this enough? In terms of the activities that the adaptation finance went to, they were going towards activities in the water and wastewater management sector, agriculture and forestry, and disaster risk reduction. And we think such investments will become more valuable to reduce the impacts of climate change over time. For example, the recent hurricanes in the US have estimated costs of approximately 300 billion in economic damages. Part of the story behind the low adaptation numbers themselves is with our progress on tracking methodologies. By definition, much expenditure from adaptation is integrated within projects, especially when it comes to private investment, so it can be difficult to parse out those specific numbers for adaptation and include it in our estimates. And similar data limitations and gaps, particularly in domestic government expenditure when it comes to public procurement, but also private investments in energy efficiency, transportation, land use as well, hinder our ability to capture a full picture, but we are working on solutions to cover these areas in the future. Geographically, where is the most active in terms of destinations for climate finance? In the non-OECD regions, East Asia and Pacific is the largest destination at about 32% of the overall flows, mainly due to a lot of activity in China. In OECD regions, Western Europe and the Americans are also strong, with growth of 11% and 28%. The largest movers across the years we found were actually in South Asia, which grew by 48% to 22 billion over 2015 and 2016 compared to 2013 and 2014, and this is mainly due to much more increased activity in India. We also look at where the money has come from, and over the years there has been a strong theme of domestically sourced investment, illustrating how important the national policy and regulatory frameworks are at channeling investment towards climate solutions. We found that 92% of the private finance itself was spent domestically, but in total this was 79%. So we often look at, before I go over to Tom, I thought that we could, who will talk about the investment case for scaling up climate finance flows. A helpful framework to target efforts is through addressing specific policy, knowledge and risk gaps that vary across the regions, sectors and investors themselves. And Barbara will touch on these a little bit more later when discussing some specific solutions. But for example, on policy gaps, much work has been done on the policy side in scaling up investment, particularly in renewable energy, but there is still a lot more to do in many other sectors. Knowledge gaps, we are noticing awareness and demand for data and knowledge increasing, especially around the financial sector and the pricing of climate risks, but that is still yet to filter through to action and investment decision making on the ground. And thirdly, around risk gaps, there are still specific barriers related to access to finance and difficulties in terms of risk perceptions, in particular in specific large emerging economies and certain technologies and sectors that may be addressed through potentially innovative financial instruments. So without further ado, I will pass over to Tom.
Great. Well, thank you so much, Barbara and Padraig, for setting the scene here. Just wanted to verify you can hear me. Can everybody hear me? Okay, good. So I'm really happy to join this. I think that anything we can do to sort of demystify the climate finance landscape and also tell what's needed is really useful, because my job at IFC, sort of leading climate change policy, is to translate what's happening with NDCs and COPs and Paris into something that our investment teams and our clients can understand. And so I think that it's great to do these sorts of seminars to explain exactly where we are and then where we need to scale up. IFC itself is an active participant in the climate finance marketplace. We are the sister organization of the World Bank, and we are the largest private sector development bank. Last year we committed about $3 billion, last fiscal year about $3 billion of climate finance and about 95 projects across over 40 countries. And so we are very keen and see a lot of opportunities in a lot of sectors. And what we were hoping to do as well is we feel very strongly, echoing what Padraig just said, that there is more work that needs to be done to get the policy landscapes correct in some of our key countries. Because one thing that really I think still needs to be explained better is that a large amount of the infrastructure and the investment in climate finance is going to happen in the developing world, in the emerging markets, and the lion's share that's going to have to be private finance. And so there's a key challenge for us all, is to think through how do we attract more private finance for climate solutions in emerging markets. And so IFC, of course, is very keen to be part of that conversation. So you see here the cover of a report we came out with for COP this year. It's actually the second in a series of reports we did. The first report we did was called the Climate Investment Opportunities Report. That came out in Marrakesh 2 years ago. And what we did there was to try to translate these NDCs into something that was understandable. We looked at 21 of the largest countries that we operate in the emerging markets, looked at their NDCs, and we made the assumption that they would achieve their NDC targets by 2030. And then we wanted to translate, so if they did that, how much investment opportunity does that represent across the various targets in renewables or transport, waste, and other sorts of targets. And so we came up with a figure of $23 trillion was the size of the prize, if you want to say it that way. In terms of if these countries achieve their NDCs, this is how much money will be represented in the investment. So following on that report, we felt then that was sort of the size of the prize, but then we also needed to do some work in, okay, how do we unlock that private finance for those key sectors? And so this report called Creating Markets for a Climate Business is one that we came out with that goes through 7 of the key sectors. So I'll talk a little bit more about that. And I'm trying to advance the slide here. Let's see if that works. Am I supposed to be driving here? I'm doing page down and it's not advancing. So if it's, there we go. Okay, so what we did was actually look at the policy landscape. So how are countries creating markets by putting in place the right sets of policies? So here you see a handful of countries that we think are making good progress. I think that, and maybe a broader way to look at it is one bucket of activity we think are really critical is getting the prices right. And so first thing countries need to do is remove fossil fuel subsidies. And we are seeing progress there in places like India and Morocco, Ethiopia, and others. But then also you need to be starting to price carbon in a way that attracts private investment and levels the playing field. And there we've seen actually quite a good amount of movement in pricing carbon in a number of jurisdictions, whether it's China with their new national ETS announced just last month, or it is Argentina recently announcing a $25 per ton carbon tax, or it is South Africa moving forward with its carbon tax of around $10 a ton. Singapore has announced its carbon tax, and then also some developed countries like Canada and France they're building on existing carbon pricing programs and sort of setting the floor higher, and that is making it very attractive for a lot of investments. So that's number one, getting the prices right, and then I'll add to that it's not just about carbon, that one of the key messages we had for urban waste and water infrastructure is to get pricing right for waste and water, because if you start to generate a revenue stream for water or waste, that directly goes to the utilities' financial stability and makes it a much more attractive investment for the private sector. So that's bucket number one. I think second is market responsive support policies. So whether it's renewable energy auctions, which are delivering some of the lowest prices for solar or wind around the world, that's also supplemented with things like undiscriminatory access to the grid, and then also grid planning and integration for intermittent resources. So that's the second category of policies. I think third are other standards like green building codes, or things like setting targets for electric vehicles and standards for electric vehicles. We're seeing a lot of countries do that as well. And then the final bucket we looked at, especially because in the urban context, this is very important for attracting private investment, is developing public-private partnerships that can be set up frameworks that will attract the private investment for things like bus rapid transit, things like light rail, things like wastewater treatment plants. So this map here shows some of the countries that are making progress in some of those activities. And now I'll go to the next slide, which is an overview of the report itself. So what we tried to do here was that there's a lot of activity going on in the climate investment space, as you saw from Padraig's slide earlier. There's a lot of sectors that are attracting investment now, and we've been doing this for quite some time. And so we thought it was important just to collect, first, what is the current market snapshot? How large is the market? And then where do IEA and other analysts see the market going? So we did a market snapshot and growth potential. We then looked at proven case studies of policy frameworks, business models, and different financial innovations that have been seen in practice, and whether it's IFC, whether it's other MDBs or DFIs, or whether it's just the private sector itself, these have been shown to attract private finance. And then we ended the report with looking at different each chapter has a bit of the different initiatives and resources that are available for that particular sector. And so it's a very rich report. I'm only going to touch on a few things today given the time constraints. And so if you go to the next slide, I'm going to talk a bit more about some of the financial innovations we're seeing for some of the key sectors. So in the area of renewable energy, there has been a lot of good financial innovation. I think, most people, you're seeing, as I mentioned before, the prices are coming down, so renewables are competitive in a lot of markets. But what we're seeing here now is more innovation around things like distributed generation or warehouse solar programs that securitize assets. You're seeing things around, you may have heard of pay-as-you-go solar, which is starting to take off in Africa, which is sort of a business model that is allowing customers that do distributed or off-grid solar and also at the same time use their mobile phone and get a sort of credit score and establish himself with that. And actually, we saw one of our clients, VBox, did the first securitization of a pay-as-you-go set of customers for about $500,000 about 2 years ago. And so that's one example of some financial innovation we're seeing of securitizing assets in the solar space. There's a few others that are listed here, and I encourage you to look at the report to get more details on those. The second category at the next slide, we see there's a lot of excitement and interest in the private sector around climate smart agriculture. This is things like reducing methane from animals, livestock, and making animals production more efficient, as well as things like crop productivity enhancements and use of cleaner energy, and then reducing food waste and loss is really how we define climate smart agriculture. So here, the classic problem here is that a lot of the smaller farmers don't have access to finance, and they have very volatile revenue streams given the impacts that they're seeing already because of weather and climate-related impacts in the droughts and the floods and things like that. And so one example was in climate finance innovation is our global warehouse finance program that IFC is doing together with the Global Agriculture and Food Security Program, where it allows banks in different countries to give advanced credit and resources to farmers to enhance their investments in resilient crops, and also the financing is combined with training so they know these sort of business practices. And one great example, I encourage you to go to the IFC website. We have an IFC Creating Markets website. We have a great video and story around our Sofatex cotton project in Burkina Faso, which Burkina Faso happens to be the largest cotton producer in Africa. The farmers were suffering from unpredictable crop yields, and we offered them money from this Global Warehouse Finance Program, and also combined with this training support, and they're now learning about water smart practices and crop rotation, and we expect to see more resilient crops and cotton in the country, as well as job creation and a 30% increase on yield. So it's a sort of a win-win, and it also counts as something that's sort of going to adaptation. So I encourage you as well, there's a full chapter on climate smart agriculture that give you more examples. The final slide here on green buildings is an area that IFC is very bullish on. This is one of the largest potentials we see for growth in climate finance. There's a lot, particularly in Asia, where as the citizens are moving to urban settings, we see a lot of potential for both new and refurbishment of buildings. IFC has something called the EDGE program, which is a green buildings standard and certification system that's operating now in over 130 countries. And it works on both existing and new construction buildings across building types, whether it's hotels, whether it's office buildings, retail, warehouses, hospitals, all sorts of things. And so there's a lot of innovation you can see here. I think just to highlight that we are working with a client called International Housing Solutions in South Africa, looking at sort of low-cost green, affordable green housing in that country. And there's also some interesting things we're seeing working with the banks around green mortgages. And then securitization of those mortgages is starting to happen. You can see here the example of Rabobank getting involved in that. And so these sorts of financial innovations, I think, are replicable, and we wanted to share those with the world, giving this example through the Creating Markets report that we produced. And so I think I'll turn it back over to Barbara to conclude. Thank you very much.
Great. Thank you so much, Tom, and thank you so much for sharing the main insights, and encourage everyone to go and look at the report. It certainly has brought together a lot of really interesting evidence and solutions for how you can address the challenge of scaling up investment. And I'd like just to conclude, before concluding, mention one more initiative that also aims to unlock private finance at scale, which is the Global Innovation Lab that was launched in 2014 and which CPI is managing. And this lab brings together public and private actors to really address the persistent investment barriers by adopting a new approach. It does so by identifying, developing, stress testing, and then supporting the piloting of specific climate finance instruments, which again are scalable and replicable. And Tom actually has mentioned a few that initially came out from the lab, like the International Housing Solutions was one of the lab instruments within our FIRE program, and warehousing solution as well within our India lab. So I think I just would like to really kind of give you the highlight here without being able to go into some of the specific examples, which again you can find on our website and which we'd be happy to share afterwards. I think the main outcome here and the main finding here is that really public-private initiative that is focused on developing scalable and replicable innovative solutions really can have an impact, even though it's very small. We have managed in a little over 3 years actually to launch over 20 instruments and initiatives, which together as of today have mobilized almost $1 billion for concrete projects around energy efficiency, renewable energy, land use, and housing in cities around the world. And the lab itself has been endorsed also by the G7 and also by the Brazilian and Indian governments. And so it does show that there really is a niche and an opportunity to really think about how you can come up with like the right instruments, innovative instruments that really can use public finance most effectively to unlock private investment at scale around the world. So now just moving on to our next slide, I do want to say we have been focusing on developing countries in our work to make sure that we really kind of come up with the right instruments that help them leapfrog some of the trends that we have done in developed countries. And as Tom was already said, there is already a lot going on in developing countries as regards to regulatory frameworks. I do also want to mention that we just very recently have published the first global renewable energy finance landscape together with IRENA, which has a lot of very interesting information on related policies with respect to renewable energies around the world. And I think what we see in our work that within developing economies, there are significant opportunities to increase investments in clean energy, with many of these countries already offering very strong investment environments. And blended finance, which again is the focus of the lab, but it's going beyond that, can really play an important role in addressing the risks and the barriers that are faced by investors in realizing these opportunities. And Patrick has given you a very brief overview of the main risks that we see in our work with investors around the world. So what we see is that developing economies that are most suitable for blended finance are sub-investment grade countries in East Asia, in Sub-Saharan Africa, and in South Asia, especially in India. And in fact, our work shows that there is around 369 billion of investment opportunity in the 8 high-impact countries that are highlighted here on this slide. Economies within these regions have a baseline of private sector investment readiness. They do have very strong potential to achieve impact on climate change or on energy access more broadly, but that they have ongoing needs for blended finance to really bridge gap commercial viability. So if you're interested in learning more on this specific piece of work that we've done, we will be releasing tomorrow our blended finance and clean energy clean energy report that was commissioned by the Blended Finance Task Force, which will be available in full on our website. So let me now move on basically to what is next and really trying to understand, what are some of the trends for the outlook going forward. And so the first one I'd like to mention is, I think while the impacts from the Paris Agreement haven't been seen directly in our numbers yet, the Paris Agreement clearly does mean that the majority of nations are working to implement climate plans, many of which also include investment pathways. And the Article 2.1c of the Paris Agreement includes a long-term ambition to make finance flows consistent with pathways towards low greenhouse gas emissions and climate resilient development. And so we do see a real opportunity to scale here by focusing on how you can articulate a long-term and systematic finance goal in an international agreement that really can engage financial system actors, as well as to make sure that the efforts are ongoing to ensure that domestic governmental spending as a whole is consistent with the 2 degrees pathways. Second, Padraig already has mentioned a number of them, but what we see is that there are really numerous initiatives that engage the broader capital markets, the financial system, and also large corporations to align with low carbon and climate resilient business practices. And we really see that they are becoming more commonplace. I won't go into all the examples we have, but I would like just to very briefly mention the Task Force on Climate-Related Financial Disclosure, and the Article 173 for French-based investors truly require that reporting on portfolio alignment is really taking into account the need to being aligned with the low carbon transitions. And I think this does underscore the potential for more active regulatory environments governing asset allocations by investments. So coming back to what also Tom has said, I think an opportunity to scale investment is really for governments to adjust their regulatory frameworks to create strong incentives for private investment. Third, we do see that efforts to green existing public financial systems are beginning to take root, while we obviously know that there is more work that needs to be done in line with some of the data availability gaps that Padraig has outlined before. But we see that since 2011, efforts by public finance institutions have contributed to greater transparency and clarity on levels of funding for climate resilient versus dirty investments. But sectors in need of significant adaptive capacity to climate impact, such as water supply, agriculture, and general infrastructure, requires still a greater focus. And so we do see that there is really a need to continue providing better clarity on the overall landscape of climate finance. And based on that, we think that really governments, public agencies, and also development finance institutions can help and equip businesses with the information and the tools that they need to integrate climate information into investment decisions. And finally, and again, that's coming back to a lot what Tom has mentioned as well, I think what we see is that new investment vehicles are on the rise, and many of these targets institutional investors that manage mostly untapped but significant portion of the global capital. And as Padraig has shown, the landscape tracks new and primary investments into projects, but therefore does not capture some of the refinancing or the other activities that institutional investors are doing. So while we see that they're still kind of at the low level percentage of total landscape flows, we do see through the lab and through other initiatives that there are really investment opportunities tailored to these investors that are under development. And therefore, we do see that there is a real opportunity that new and innovative financing instruments can strategically use public, mostly concessional capital to de-risk some of the green projects and therefore drive private sector investment in developing countries. So with that, I think just to conclude here, I think what we see is that innovation in policy, in technology, and in finance can help getting us there, or getting us towards a general kind of increase in the investments needed to getting us towards the Paris Agreement. But certainly much more needs to be done, and I look forward to hearing from others also and getting questions from others on how we can make sure that we work all together towards this overarching goal.
Great, thank you, Barbara. We will now take questions. As a reminder, you can type your questions in the chat box in the lower right-hand corner of your screen. And it looks like we already have a couple, so we can get started. Our first question is on adaptation finance. Why has it gone down when there appears to be a lot of need for it to increase? And what is your view on whether the private sector is getting interested in adaptation finance beyond climate-smart agriculture? If so, what is of interest or likely to be of interest to investors?
I might take an early stab at this one, and then I might ask Tom to come in on the private sector interest. Why have the numbers gone down? Well, specifically, we go into it in a bit more detail in the report itself, but when it comes to public sector investments, the National Development Bank category is actually one of the largest actors in the public sources of finance actor, as well as the other types of actors that we would have would be bilateral finance institutions or multilateral finance institutions, as well as climate funds and donor governments themselves. So in the National Development Finance Institution category, we noticed that overall in both mitigation and adaptation, there was a bit of a drop in financing for climate finance, and that was largely due to a few factors around economic volatility in emerging markets and also currency valuation changes across those years. Some major emerging markets saw quite stark changes in their currency, in the value of their local currency to the dollar. That would have been a bit reflected in how we calculate the numbers over the years. But that's the overall picture. When it came to adaptation specifically, they did then also more than in mitigation decrease their spending, whereas the multilateral financial institutions such as the World Bank, IFC, and a few others, did increase their adaptation spending over that period by comparison. But because the National Development Bank category is such a large category, it meant that the overall public adaptation figure went down. And part of the reason why this is also because of difficulties in tracking and reporting and measuring that adaptation finance figure in those by those institutions. Adaptation finance itself is defined by various different organizations in different ways, and often what we try to focus on is the specific expenditure related to an investment that does result in the adaptation difference through the project rather than the total investment in the project itself. So for example, you might have a water infrastructure project, but of that project investment, maybe 10% is related to adaptation spending, and we would just count or aim to count that 10%. And so that method in itself makes it a bit difficult for a lot of organizations to report, therefore, on what that figure should be across their projects. It also makes it a bit difficult to understand from the private sector what that figure may be as well. And so therefore, our adaptation figure is very much not the whole picture, but is the whole picture that we can capture at this stage. It also, as Barbara mentioned at the end, our method it does seek to come to a non-double counted figure for climate finance flows. So that means we do focus on direct debt and equity investments. We don't count refinancing of projects that have already happened or other secondary financial flows like that. But it also means we don't count insurance flows too, because that would not result in a direct investment. Whereas insurance in itself would often be would come to mind as a climate adaptation financial flow. We don't include it in our figures at the current moment in time. Tom, would you like to touch on the interest of private investors, I should say, in adaptation sectors?
Yeah, just briefly, I think I wanted to, there was the question said other than climate smart agriculture, but I do want to just point on that actually there is a lot of interest in climate smart agriculture, and we just at IFC created a definition for how we track climate finance in this area last year, and we went from $0 to $700 million that winters climate smart agriculture just last year in 1 year. And so I think that there is just a data challenge and a sort of methodological challenge around counting it. But I think there is a huge amount of interest, and as we went through the business models of these companies we were investing in, there was a lot of check marks and sort of, yes, they are doing these sorts of climate smart agriculture measures. And so I think that's a bright spot, and there's probably just the tip of the iceberg. There's probably more going on that we aren't tracking so well. And I also just wanted to emphasize your point about perhaps it's not the total dollar amount, but it's maybe the number of projects that have a portion of adaptation finance, because as you say, you know, a good example is we had a project, a port facility in Colombia a few years back that we worked with the port to call attention to the potential sea level rise, and they then increased the investment. I think it was just $10 million of a much larger investment, but that was a key investment increment to make it sort of more resilient and adapt it to the sea level rise. And so perhaps it's not that total dollar amount, but it's, you know, how many more projects are doing that sort of investment. And I think Barbara mentioned the Task Force on Climate-Related Disclosure, that sort of pressure from investors and other stakeholders around, is this, you know, are you taking into account climate risks like physical impact risks in the future, might cause more companies to make those incremental investments to make their infrastructure and other assets adapt or be resilient.
Maybe just one last addition to that. This is Barbara here. You know, just to say, also in the context of the lab, we actually see a lot of interest into adaptation instruments, also from the private sector. We have seen in the work that we've done that really there is we have endorsed actually a number of financial solutions for various sectors that are in the adaptation space, such as agriculture, as Tom said already, but also in water and risk analysis more generally, and for resilient businesses, where we have just helped basically launch the first private equity fund to invest in companies that provide climate resilience products and services. So what you can see really that there is a lot of appetite. There's clearly still the need for some help from the public sector, both as regards information or policies, or as regards some specific concessional funding at the beginning. But we certainly see that private sector has become very active and is starting to also recognize the opportunities in this sector. Certainly there's much more that needs to be done, but I do think, and I agree with others, that there is, you know, I think we certainly are showing the lower bound of what actually is happening on the ground.
Great, thank you. Our next question is on the current level of public and private leverage. What does it need to get to 1 trillion per annum? Patrick, do you have some thoughts on that?
The current leverage when it comes to direct investment that we measure is approximately 2 to 1. It varies throughout the year from 34% of public finance, but in some years it can be up to 40%. But we saw earlier in the slides, in the graphs, that the private sector is doing more year by year, so that kind of leverage factor is improving. However, just a word of caution that we are counting direct investments here. We're not counting other financial instruments that may be considered, such as guarantees and insurance and other investments like that. In terms of where does it need to get to, it's a very tricky question to try to answer. I'm not sure if there is a correct answer on that one. It very much varies by the level of economic development, the sector, country risk factors, etc. So we probably won't have a clear idea, and anyone that would come out with a number that would say it would be very much open to debate. So we're not quite sure on that one.
Are there any good examples of specific actions that national level governments are taking to help their companies access climate finance funds? Are there specific funds which are more easily accessed by the private sector? Tom, perhaps do you have any thoughts on that?
I was just going to offer, I don't have a huge set of examples there, but one was highlighted, I think, in the slide with the map, the country of Colombia. The Ministry of Finance recently issued something called Colombia Sostenible, which is a new fund that they are creating, their seed funding, that is designed to help drive private investment in their NDC implementation. It was announced last fall at the World Bank annual meetings. The finance minister came, and I think it's a great new development. But that's one example I know of where the government is forward thinking and sort of from the finance ministry taking charge to try to attract finance and leverage. Use a bit of public funding to draw in more private finance. But I don't have more details than that.
Thank you. Our next question is whether there is much evidence of crowding in the private finance versus crowding out of private finance.
Yeah, maybe this is Barbara. This is a tricky one. But I think what I see as some good trends coming out from our work is that the percentage, basically the share of how much the public finance is kind of contributing and investing in specific technologies does give you a pretty good, understanding of where the technology costs that have been going down actually have really helped to create a more viable investment environment where the private sector actually is going stronger, focusing on stronger. So I think it is like we can see that for the first time, as Frederic said, the public investment into energy efficiency has overtaken renewable investment into, and again, there's also, we've shown in the report with ARENA, technology costs for particular onshore wind and solar PV have declined significantly over the last few years. But that can show you that actually the fact that the costs have gone down, private sector has increased investments in these areas, and the public sector has increased investments in these areas to indicate that there is a good trend in at least enabling the private sector to basically take a stronger role and where they perceive the risks to be lower. Certainly, there's still a more general need to make sure that public money is spent most effectively and is not crowding out. I do think that there are some examples still where development finance institutions continue to focus on some of the technologies that by now are pretty much competitive in most of the markets. But I don't think that there is a general kind of number or general issues that we can mention here. I think it's really much on a case-by-case study, but I think the general trend certainly is going in the right direction. But I would encourage everyone to help kind of finding ways in ensuring that there is new business model that use this public concessional money most effectively to really ensure that we get private sector to the scale that we need to close the gap.
Our next question is whether there is any information or data on sources of climate finance from recipient countries, apart from what we've already seen in the landscape. Patrick, perhaps you could answer that.
Yes, there are some significant pieces of data. We capture a lot of flows that go directly from national level development finance institutions, and these are often in developing countries themselves or emerging markets, or they are regions of developing countries that work together, especially in Latin America or in South Asia and Southeast Asia, and in Africa, of course, as well. And so when it comes to direct investment in new projects, they actually are a major player in capturing that. There is still not so much good data sources in terms of domestic government investment in projects. So, for example, through public procurement directly. That is investment that they wouldn't channel through a state-backed development bank or a state-owned corporation. We would be pretty confident of being able to track those flows, but investments that come from public procurement, there is still very limited data on that. what is reported through the UN and other sources is often not consistent or not standardized in terms of how that data is presented. So that is still one significant data gap that we have on that aspect. And I think I can go on to the next question as well about the level of participation by domestic private capital in climate finance. So it is quite high. We saw that of private finance flows in total, 92% were from domestic sources. And this is not too unsurprising given the fact that project developers and commercial banks are more likely to be investing in projects, especially climate projects, that in areas that they know of from project sponsors that they are aware of, and with country risks and political risks that they're quite familiar with.
Great, thank you. Our next question is, how is the development of green and resilient investment banks supporting the acceleration of climate finance? Barbara, perhaps you have some thoughts on that?
I think this is a really important question. I think we have found in a project that we've done as the Inter-American Development Bank on 12 national development banks in 3 of the large Latin American countries, in Chile, in Brazil, and in Mexico. We have seen that these banks actually are very well suited for increasing their investments into climate because of a few characteristics that they have. They're very well connected, obviously, to the local governments, but they're also very well connected to the local private investors and really understand what are the key barriers in the specific countries. So what we see is that they already are investing quite a lot, but if you look at the needs in these countries, there really is a pretty big shortfall. But what we have found in our work is that there is really some pretty easy ways basically to help them scale up by really focusing on a few of the issues that I've mentioned already in the webinar, which is like really trying to understand better where investments are going, helping them focus on how they can better structure some of the climate relevant projects, and making sure that they're like working with other multilateral banks to come up with new and innovative climate financing mechanisms to scale up their investments, particularly in sectors where they're not that familiar with. So I do think that these banks have a role to play. They're well suited, and I think there is the new ones that have been mentioned in the questions as well. I think we've seen that, for example, the Asian Infrastructure Investment Bank and the New Development Bank have already committed around $2.5 billion in the last years to climate investments. So I think they will be really helpful in ensuring that we can continue to scale up the investments in the country, which, again, Patrick has shown is where most of the flows are actually happening. So again, I think I'll leave it here.
Yeah. Do the presenters have an issue with double counting of ODA financial flows as new and additional climate green finance? If so, what are the potential solutions? Also have thoughts on that one? Okay, we'll move on to the next one. Does the panel see blockchain as helping to enable climate finance, micro and large scale, including supporting transparency and verification to create a better risk profile and lower transaction costs? Tom, do you have any thoughts on that one?
I was just thinking, I mean, I keep hearing about this sort of question, and it sounds very promising, but myself, I haven't, other than, the conceptually sounding like a potential solution, I have not seen any sort of business plans or models myself. I don't know if Barbara or Padraig have.
We do get a fair few submissions related to blockchain as part of the Global Innovation Lab for Climate Finance. We're yet to kind of see one come to fruition, but it is certainly an exciting potential area. But very much with a lot of these new innovative technologies, there's still a long way to go to test and verify that it will work. But hopefully we will see some action in the future on this.
Great. And lastly, what can we do to bring more financial institutions and ministries of finance to climate discussions? Does anyone have any thoughts on that?
Yeah, I'll take a crack at that. I think it's a great suggestion, and it's something that's starting to bubble up a bit. I mentioned the Minister of Finance for Colombia. We have the Ministry of Finance in Argentina. We've got Morocco and a few others that are part of a program that's emerging out of the World Bank called the CAPE. I actually forget the acronym, but you can look it up online. It's I think it's around it's basically fiscal policy for climate change, and I think that Isabel's right to say that that we need to have them at the dialogue, and I think that there are a couple of hooks for there. One is they're starting to see taking action, whether it's doing things like removing fossil fuel subsidies or pricing carbon. All of a sudden, there's an interesting intermix of revenues that they can play with to deal with other fiscal issues. Whether it's tax reductions and things like that, aligning things like reducing labor or income tax and while raising carbon taxes, for example. And I think in a lot of our emerging market economies that it's seen as maybe you set a lower price and you start to increase it over time, and it's a way to tackle both climate change and growth. And so I think that's a very exciting development, but we need to see more discussions and that get to other ministries of finance. It's just a handful right now. I think one other platform that could be useful in this respect, the IFC runs something called the Sustainable Banking Network, which I think is about 23, 25 emerging market countries, and it includes central banks, financial regulators, and banking associations. So it's sort of a public-private mix, and they're looking at green finance and climate finance, and there's a lot of energy around that. We're just, I was at a meeting here in Zurich today where Dr. Ma from China, that's led a lot of the green finance, was talking about the next steps, and they're just about to issue a progress report at the end of the month. And I think more sort of public-private dialogues in the country around their climate NDCs, and then bringing the Ministry of Finance, like we've seen, giving a few examples like we've seen in Colombia, I think will go a long way to getting more finance ministers to this discussion.
That completely agree, Tom. And I think, again, in the lab, the global lab, but also in the regional labs that we have in Brazil and India, what we do try to do is really bring these different financial institutions and treasuries together. So we have, if you look at the lab members which are on our website, you can see that we have pension funds, we have insurance companies, we have development finance institutions, we have project developers, we have commercial banks, and we have governments often represented by their treasuries, which really are part of this public-private initiative and this dialogue. And we get a lot of good feedback from them that they actually learn a lot by kind of having this chance to kind of communicate with the different investors and sitting around the table and really understanding what are the barriers and what are the opportunities and what are the needs of the different actors. So I agree. I think excellent question, and certainly something where we need to continue to focus on.
Thank you. This concludes our webinar. Thank you very much to our presenters for the great presentation and to all of our participants for your interest and questions. As a reminder, this webinar will be on our website in the coming days. And if we weren't able to get to your question today, please feel free to reach out via email. I'll put my email in the chat box now. And like I said, just feel free to ask any questions that we didn't get to. Thank you and have a great day.